Okay, wonderful. Let's go ahead and get started. My name is Kathy Lien, and I am managing partner of bkforex.com. I'd like to welcome all of you to this very special session, Making Trade Calls Like CNBC Experts. Before I begin, I would like to share with you this disclaimer. So if you bear with me, I will just go ahead and read through this. Past performance is not indicative of future results. Trading Forex carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade any such leveraged products, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware, hold on, let me just close this volume window. Sorry. You should be aware of all the risks associated with trading on margin and seek advice from an independent financial advisor if you have any doubts. The information, including commentary and trade ideas provided on bkforex.com, should not be relied upon as a substitute for extensive independent research, which should be performed before making your investment decisions. At BK Forex LLC and bkforex.com, we're merely providing this information for your general information. The information and opinions do not take into account any particular individual's investment objectives, financial situation, or needs. All investors should obtain advice based on their unique situation before making any investment decisions and should tailor the trade size and leverage of their trading to their personal risk appetite. BK Forex LLC will not be responsible for any losses incurred on investment made by readers or clients as a result of any information contained on BK Forex LLC. BK Forex LLC do not render investment, legal, accounting, tax, or other professional advice. If investment, legal, tax, or other expertise is required, the services of a competent professional should be sought. Okay, so with that, I want to start by saying that there's a lot of experts and talking heads on television. You may or may not have seen both myself and Boris appear on CNBC often, and these are the people that you would think are experts in the industry. And particularly, regardless of whether it's the CNBC's Money in Motion show or Fast Money or any other show, these are the people that you turn on television and they provide you with trading ideas, trading advice. So the question here, are talking heads on TV really all that smart? Well, considering that we've got, oftentimes the octagon happening on CNBC, and we've got lots of conflicting views. We'll let you decide. Because, I go on television often, and I will tell you that and I think that this is, very wrong, that basically, how do I put this? Basically, headlines sell, or extremism sells. So a lot of times you'll see someone, I think, recently we had someone on the show say that they were targeting 5,000 on gold. So in terms of, 5,000 gold, he was looking at 5,000 gold by the end of next year. And if you remember, some people were targeting 5,000 gold by the end of this year. So why is 5,000 a target? 5,000 is a target simply because it's a huge, shocking headline number. And then you have people arguing for these huge moves because it's much more interesting to say that, much more likely for you to go on TV by saying that, gold, making a call that gold is going to go 5,000 than making a call that gold is going to 1,750, which is not too far from current levels. So basically, extremism sells. And that's what you hear a lot about on TV. And the same is true, not just of business news, but also, political news, where people make these really, really large claims, which they may or may not believe in. And, you as the audience sit down and you hear this and you think, okay, oh my gosh, gold is headed to 5,000, or euro is going to parity. I think recently we had someone say that euro is going to parity. And you think, okay, this must be where the currency is headed because the so-called expert calls it there. I'd be really careful about these calls because these people get themselves on television by making these extreme claims. So then that's why I let you decide whether you think that the talking heads are really all that smart, because the way that they've gotten themselves, on television, oftentimes, is because of some of these extreme calls that they would make. But, I go on TV, and that's not to say that you shouldn't necessarily question what everything that I say, but you should, think about whether it relates to your trading experience and your trading ideas. Because even though, talking heads may make, relatively large claims, one thing is certain. And the one thing that is certain is that most people who are invited to, on CNBC to talk about, or even on Bloomberg, to talk about where they think their markets are headed, do have years of experience. And in some cases, in our case specifically, we have years of experience in the cold, hard reality of trading, which is not easy. So what you need to do is you need to look beyond what the big, kind of large claims that they're making and listen to the true messages. Like, for example, the person who came on and made the 5,000 gold calls last week on our CNBC Money in Motion show, his real reason, his underlying reason for making this was because he believed that we would end up having inflationary conditions as a result of all this easy monetary policy from central banks all around the world. That's the only thing you really should care about and you should really know. It's not this target of 5,000 golds, because I think, in my opinion, I'm bullish gold, but I think the world would have to come to an end for gold to go from its current price of 17-ish to 5,000, because that would be a huge move in gold prices, and that would probably, involve people bailing out another, financial crisis or another, major meltdown in the sovereign debt crisis, which, I don't think necessarily would be the case in 2013 and 2014. But what is probably likely is that, gold will probably trend higher, because he's probably right that, inflation will be created by all of this super easy monetary policy. So the takeaway that you should have from his years of experience, and the real message that you should take away from this, is that gold, is likely to head higher. 5,000 may be, an overly ambitious target, but you need to look beyond the calls and listen to the real messaging. And the same is true when you hear myself, or you hear Boris, or you hear, any other expert go on television and make these crazy calls about how, well, we don't make crazy calls. We usually have much more nimble targets. But some people, they make crazy calls about how, Aussie is headed to 130, or, Euro's headed to parity. It's not so much that Euro is headed to parity. I sincerely don't think that, it would be. But that whoever's making that call is really telling you that they are bearish Euros for X, Y, Z reasons. And so I think that's the most important thing to take away. Now, one of those things that you have coming up is the fiscal cliff, and we'll take a look at the, a chart that I've included here about how bad things can get for as a result of the fiscal cliff. But once again, it's not so much about, how much the economy is going to contract, how much of a decline in GDP growth that we'll actually have, but more the story that if we do fall off the cliff, it will be negative for growth. It will be negative for, probably negative for consumer spending as a result of higher taxes and so forth. But it may not yield the sharp pullback in growth that some people are making these calls with. So my point is, one thing is certain from the people who are invited on television is that in some ways they've earned it by, either being in the market for a very long time, or at least having some solid reasoning for their calls. So that's really important, because experience is a key to refinement. And we as well as many other CNBC experts have traded through many different market conditions, and thoroughly understand at least some of I can't speak for everyone else, but we thoroughly understand the fundamental drivers of the FX market. Most of us, because we've been in the market for so long, watch multiple markets at the same time. And so, we have more of a holistic view of the markets rather than looking at FX specifically. And in the case of ourselves, we developed and refined trading strategies, and we actually trade real money. So even though, we'll let you decide whether or not the talking heads are really all that smart, I think that it is important to realize that experience, that there is something to take away from experience. So when we go on, CNBC and we make our trade calls, we usually look for we usually look for support from 3 different factors, because we believe that, sorry, let me just take a sip of water. We believe that there are 3 key ingredients to a perfect trade. And those ingredients are fundamentals, technicals, and sentiment. Every single one of our trade incorporates fundamentals, technicals, and sentiment. And when we go on, and we give our trade calls, it's a lot less about that we don't just provide one reason, we provide multiple reasons for why we think a trade is good. And sometimes, our opportunity to speak, especially during the midday hits, is very short. Because when we do CNBC Money in Motion, we have an entire 30 minutes to talk about our trade. But when we're doing the midday hits, either on Squawk Box or Fast Money Halftime Report, we're given like a minute to talk. So, we may only be able to provide our strongest reason for why we put on a trade. But every single idea and the way you should think, and if we're talking about how you make trade calls like CNBC Experts, the way you should think is to basically look to make trade calls and trade ideas based upon potential opportunities that's supported by all these factors: fundamentals, technicals, as well as sentiment. And when we give our trade calls, we obviously provide, stops, buy, targets, levels. Last time I was on CNBC, and I encourage you just Google CNBC Money in Motion. You can watch our show on Friday. I talked about going along dollar yen on a dip to 81.75. Earlier that week I had a euro dollar long call, buying at 129, targeting slightly above 130. So, definitely take a look at that. So some of those things are playing out. So, rather than run you through all the different calls we've made, I think you're much more interested in how we make trade calls as CNBC Experts. And the way Boris and I do it is we take a top-down approach to looking at the markets. We start with the big story, and we start with the main factors that are impacting the markets. One of the main, we have our clients at BK Forex in a long euro dollar trade right now, and past performance is not indicative of future results, but we were lucky enough to hit our first target, right before coming on to this webinar. And our core reason for putting on this trade, and something I've been writing about, talking about, is for the past week, is that we have a kind of divergence in the size of the balance sheets between the U.S. Federal Reserve and the European Central Bank. The U.S. Federal Reserve this Wednesday is gearing up to expand its balance sheet further, because what's going to happen is the Federal Reserve, Operation Twist is coming to an end. So what they need to do is they need to announce a different program, because there's no way that they're going to leave the economy with less stimulus, because Operation Twist is ending come December 31st, as we walk into the threat of the fiscal cliff. There's no way that they're going to leave the market with less stimulus. That is why they're going to replace Operation Twist with a new program in the beginning of the year. And this new program is, and I encourage you to read the piece that we wrote on this on bkassetmanagement.com, where we have our research notes, where we write about how the most likely scenario is they're going to come up with a decision to buy treasuries, just take all that money and buy treasuries with it. And at the end of the day, it's going to leave the market with more stimulus, because they're continuing to buy long-term bonds, but they have run out of short-term bonds to sell. So there's going to be no more pressure on the short end of the curve. So short-term yields won't be pushed higher anymore. And so as a result, that leaves the market, at the end of the day, more stimulative because they're just simply buying long-term bonds. So, we believe that the Federal Reserve, as a result, was going to be expanding its balance sheet. And at the same time, the ECB, yes, they've committed to outright monetary transactions. Yes, they've committed to easy monetary policy, but they haven't expanded their balance sheet because no country has asked for OMT to be activated. So on the one hand, you have the ECB balance sheet intact. You have the Federal Reserve balance sheet increasing. And if anything, the conditions in Europe are improving because European bond yields have fallen, sovereign debt risk has declined, we have the funding markets reopening, and we have the return of deposits. So that made us fundamentally positive for the Eurodollar. And then, of course, we have the DAX rising to a fresh 4-year high today. We also thought that investor confidence was going to be strong due to the stock market. So all these different reasons gave us a top-down approach of why we wanted to go long euros. But of course, that's where we start with. It's not where we end with. We start with the big stories, and these are some of the big stories that have that we look at when we determine trades. The U.S. election outcome, the European sovereign debt crisis, Chinese leadership change, the Bank of England. China has already announced its new leader who's going to take office next year, and he comes in at a very critical time in the global economy because Chinese data is deteriorating. This past week, we learned that export growth, exports rose by a mere 2.9%, which is nothing compared to the forecast of 9%. The trade deficit shrank a lot. And if this deterioration continues for the second month in a row, then we could be in some serious trouble in the markets. We don't think that that's necessarily going to be the case, but it's something that to look out for. And if we get more and more signs of the need for the PBOC to provide more stimulus, that would be one of those big stories that we'd be looking to trade. So, I want to take a look at a Aussie dollar chart with you right now. So this is a Aussie dollar chart. I was looking at this earlier today, which is why you see my trend lines that I'm drawing here, where we have a nice little wedge forming, and we're actually in the process of breaking out of this wedge. And can you just confirm to me that you can see my Aussie dollar chart before I continue, so I can make sure that everyone's on the same page? Just give me a yes if you can see my Aussie dollar chart. Perfect. Okay, so I know that you can see my Aussie dollar chart. So we were looking at this earlier with our BK Forex club members, BK Forex members, and I was talking about how the Aussie dollar is primed for a breakout. And earlier this morning, the high that we're looking at, and it hadn't broken out yet, was 105.17. Right now, we're testing that level, and I think that there's a very good, Aussie dollar breakouts have been so painful to trade. I've been looking at this for quite some time, and it's just been, the bane of my existence. But it looks like it's happening, and it looks like it's happening partially because we have a really, really nice rally in risk appetite today. So even though we had a really weak Chinese data, why is this happening? Why is the Aussie dollar so strong? Well, it's another one of those top-down approaches, and the top-down approach is that the reason why the Aussie dollar is so strong is because Australia is still yielding 3%, and 3% is really, really high yield in this market, believe it or not, these days. When I walk into a U.S. bank and the best they're offering me is 0.5%, and you go to Australia, they're offering you 4%. So, the yield is still attractive enough to encourage some investors, and that's why we're seeing the Aussie dollar. That's why we're seeing the Aussie dollar relatively propped up. So the reason why I did bring this up is because if we first look at fundamentals, we see that Chinese leadership is changing. We have some weak economic data. So that tells me, okay, maybe I want to go bearish Aussies if I believe that, the Chinese growth is going to slow further. But then what I will do is look at my Aussie dollar chart, and you can see from the Aussie dollar chart that Aussie is breaking up to the upside. So if I was trading Chinese story, there's no way that I'm going to be shorting the Aussie dollar into such a strong uptrend, especially when sentiment is so positive Aussies. So instead, if I have a reason to go long Aussies, then that would be a stronger trade. If I have a fundamental top-down approach to going long Aussies, that would be a stronger trade call for me because I would have fundamentals, technicals, and sentiment on my side. Because right now, the technicals and the sentiment are pointing to stronger Aussie, whereas the fundamentals are pointing to weaker Aussie. So because we don't have alignment of fundamentals, technical, and sentiment, you know, there's no reason why you want to go short Aussies. But if I do have a reason to go long Aussies, I would have the support from all three factors. Another example of taking a top-down approach would be maybe to look at the story of what's happening in the UK. In the UK specifically, one of the big stories next year is that we're going to have a new Bank of England governor, and it's quite surprising to people that the head of the Canadian Central Bank is going to be the head of the UK Central Bank. And the most important takeaway is that, Carney, as you see in BOC policy right now, is more hawkish than all of his other peers. He definitely leans towards a little bit more aggressiveness, a little bit more hawkishness. Obviously, Canada's on much firmer footing than the UK, but nonetheless, he is hawkish, and he could take that sentiment and bring that spirit over to UK monetary policy. Now, of course, it's not the only thing impacting the UK that you should be aware of, because Carney's not taking office until the summer of 2013. But right now, soon we'll get the release of the minutes. Next week, we're going to get the release of the minutes from the most recent Bank of England meeting. And because we do have some upside increases in inflationary pressures, and we have a continued debate within the Bank of England about whether or not easier monetary policy is needed, I am under the belief that the minutes are going to be not as bearish or dovish as most people expect. So from a fundamental perspective, I'm relatively bullish pounds. Now let's take a look at how it's shaping technically. So if you're looking at this chart with me for the very first time, you will see these lines in the chart, which are Bollinger Bands. And the outside line is the second standard deviation Bollinger Band. The inside line is the first standard deviation Bollinger Band. So right now, the pound dollar has pushed itself into the 1-2 band area up here, which basically puts the currency pair in an uptrend. So pound dollar is in an uptrend, and there's some resistance up around 160, 160, which is the second standard deviation. Actually, I would say it's more around here, which is these highs here. Let's get a thicker line going here. So basically, there's resistance at around 161.75. So there's resistance at around 161.75. I think that there's a good possibility, since the markets are bullish European assets, and part of the reason for this optimism in the stock market, in the currency market, is because people do expect the Federal Reserve to ease tomorrow. So we have some optimism in the markets. I think that it could take us to this resistance level up at 161.75. So technically I've got support because the pound dollar is in an uptrend, and then sentiment-wise we also have support because we have stocks performing so well. So if I had a reason, and usually I look for a fundamental kicker, if I have a reason to look for to go long pounds, I would have support from fundamentals, technicals, and sentiment. So once again, we look at it from a fundamental perspective, technical perspective, and then sentiment perspective. One of the huge divergences that people are talking about in the world right now is the Aussie dollar, and the Aussie dollar as well as the Canadian dollar, because we have the RBA cutting interest rates recently. We also have the Bank of Canada remaining hawkish. So let's take a look at how this is faring on the Aussie-CAD chart. So Aussie-CAD is firm. I think that we've got some overhang up at the 104 level. there's really no trade here. So even though, the point that I want to make is that even though fundamentals may tell you something, which is that, Australia's cutting interest rates, Canada's not. Canadian data has been very good, including today's trade balance report. And, the BOC is still talking about raising interest rates. Because, just because I have a fundamental thesis that Aussie-CAD should be lower does not mean that I'm going to take this trade. Because take a look at this chart. Technically, we have no reason to short Aussie-CAD. I wouldn't be going short Aussie-CAD until we have a break of this support level at around 102.90. If we have a break of the support level at 102.90, that's when I'm going to consider getting into this trade, because that's when we're going to turn bearish Aussie-CAD. And also, from the perspective of sentiment, the candle is green. Aussie is very firm against the euro. I'm not going to fade into this trend because there's probably a greater likelihood from a technical and sentiment perspective of Aussie-CAD rallying than falling. So just because I have a fundamental thesis of where I think that Aussie-CAD is going to go does not necessarily mean that that the trade is supported by that I'm going to take this trade, because technicals and sentiment does not support the trade. So you may all be interested in you may be all interested in what's going to happen to the U.S. dollar as well as the euro dollar, because that's really what most people like to trade. And I'm going through the charts of the pound dollar, I'm going through the charts of Aussie dollar, I'm going through the charts of Aussie CAD. You're wondering when in the world is she going to get to euro dollar. That's all I care about. So let's start with a top-down approach. I already talked about how how I'm bullish euros in the short term, because I believe in the balance sheet expansion of of the Federal Reserve versus the ECB. Now we have the fiscal cliff looming on December 31st, and what you will see here is kind of a really nice chart put together by the smart folks at Goldman Sachs, illustrating to you how bad things can get if the U.S. was allowed to fall off the cliff. So you see here that basically this is the dark line. The dark black line is the trajectory of the U.S. economy if Congress just kind of lets things go as they are right now. So if Congress doesn't act and allows the tax cuts to expire, this dotted line is how bad things can get, which is a huge, massive decline in U.S. GDP growth by more than 3%, which would basically indicate that the U.S. economy has fallen into recession. If tax cuts are extended, all of them, then you get this dotted line up here, which is, a nice little recovery that begins in the first quarter going into late 2013, 2014. So the Wall Street Journal, part of the reason why we're seeing the rally in stocks today is because the Wall Street Journal reports that this radio silence or moratorium on comments to the press reflects or possibly reflects progress being made on the fiscal cliff, and that they don't necessarily want to cause more volatility in markets, more uncertainty, and because they want to sit down, close the doors, and actually get stuff done. So I personally believe that we're going to have some sort of temporary deal or partial deal on the fiscal cliff, as well as a commitment to a broader deal in by April and May of next year. And that is going to be slightly negative for the markets because it's not a full deal, but it won't be the crash that you would think that would transpire as a result of this. So how does that relate to my euro-dollar trade? Well, let's get to our euro-dollar chart. Just bear with me one second. All right. So euro-dollar tested 130 today. Basically went slightly above the 130 level, and then has retreated slightly. And you can see that more clearly on the 60-minute chart, where we broke above 130, peaked above this temporarily, and then now we're back below that level. So fundamentally, what this tells me is going into the FOMC meeting, I'm bullish euros because I think whatever the Federal Reserve will end up doing will probably end up being more positive than negative euros. And we had till December 31st for the fiscal cliff, so that's basically a little bit more than 2 weeks from now. So I think for the next 2 weeks we could still see strength in the euro dollar. So from a fundamentals perspective, I have reasons for why we could still see strength in the euro dollar. The week of Christmas, on the other hand, as we head into the 11th hour, or even a few days before Christmas, maybe the 19th, 20th, we could start to see some selling in the euro dollar. So right now, fundamentals are on my side for a short-term euro dollar rally. Technicals are kind of mixed. We do look like we have a little bit of a gain, but it really needs to rise back above 130 on a firmer or more convicted basis for this really to turn in my favor. But sentiment is on my side. So 2 out of 3 is not so bad, but this is one of the shorter term trades because when we have the announcement of fiscal cliff, I think it will be more of a disappointment than anything else, and we could have a little bit of a weakness in the euro. So even if I'm long euros, I'll be looking to get out of the trade before, I would say, December 19th or 20th, because Congress is not a stranger to having fiscal cliff deals on Christmas Eve, not fiscal cliff, but major deals or major announcements on Christmas Eve, and I think that that's probably what's going to happen this time around as well. All right, so we talked about sentiment. We've talked about the eurozone debt crisis for the most part will be behind us for the rest of the year. It may come back to haunt us in the beginning of next year, especially since we have Mario Monti, based for the Italian Prime Minister, resigning, and also because we have a lot of European nations basically having to vote on this whole single supervisory banking supervisor mechanism will require some countries giving up some of their sovereignty. So there'll be votes all across Europe. Probably initially some of the votes will be nay, and that may cause some concerns about whether the banking supervisory authority can really happen. That could bring back some of the concerns. But right now the eurozone debt crisis seems to be fading behind us right now. Sentiment is actually, you see a cracked euro right now, but actually sentiment is fairly positive, as we've seen in the European bond yields, in the rally in the DAX, in the rally of the euro dollar. That sentiment is actually on our side. So I think that's something look forward to, because that's something that we basically want to pay quite a bit of attention to. So this is why some currencies will rally on bad news and some currencies will rally on good news, because earlier this week we had the German trade balance a decline, or the trade surplus and the current account surplus decline, but yet the euro dollar remained firm because broader factors such as the balance sheet expansion, the technicals, and sentiment are still, positive euros. So the takeaway is don't be caught by just short-term movements in the currencies, but it's important because you want to be on top of the broader trends. But at the same time, you have to respect technicals because basically in terms of technicals, that will tell you whether or not sentiment and technicals is essentially on your side. So in terms of technicals, entries are how are entries and exits determined? That's always very important as well. In our opinion, Can you confirm to me that you can see my slide that says how are entry exits determined? Okay, perfect. So sorry, I just had a little glitch over there. So how are entries and exits determined? In our opinion, horizontal lines are more important than vertical lines, and the reason why we say that is because while trends are very important, what is far more significant are key levels. Like 130 is a very important key level in the euro-dollar. And someone's asking, is last year's closing price of the euro-dollar important levels to watch? So if we could bring back, the euro-dollar, and let's look at last year's closing price, and we'll look at the weekly. Last year's closing price was this level here. So last year's closing price was 128.58. It is a significant level to watch, not so much because it's the closing price, but because it was also for a support level earlier earlier, not too long ago. So that makes it a little bit significant. But right now, that's where it's basically where the swing low was in November. But what I want to mention is how 130, horizontal lines are more important than vertical lines, and one of those horizontal lines is 130. Also, this horizontal line of a triple top around this area here is also more important than any type of fib retracement that you may have, or that's based upon a trend or so forth, because that tells you that significance is much more material around the triple tops and around 130 than any other place that you may see. That is why oftentimes we will, put our targets and our stops and our sells, right around key levels. It's an older trade that I had back in September. You'll see that our targets are also, close to round numbers. Usually, sometimes we'll, in our actual BK trades, we'll basically have our targets slightly above the round number, or below the round number if we're going for a specific move that we're looking at, because we just recognize the fact that round numbers are important. And the key is round numbers are difficult to break, but when they break, it is significant. And that is why we're watching this euro-dollar move so closely, because we know that the 130 break, we tested it. If we try it once again a second time, we could have a much more significant break in the euro-dollar. So that's basically how you incorporate a lot of the fundamentals and technicals and sentiment in your trades. And if there's one thing that you take away from today's presentation, I hope that it is that you want fundamentals, technicals, and sentiment on your side with every single trade. Sorry for making that too significant or too fast. So before I open the floor to questions, I want to talk quickly about what we do at bkforex.com. For those of you that like trading signals as well as trading education, that's what we offer at BK Forex. We offer, we send out day trades, positional trades, and news trades to our clients. And each of these trades, position trades, day trades, and news trades, are supported by fundamentals, technicals, and sentiment. For position trades, our process of thinking is that we establish a view on economic data first. Then we check to see if our view is consistent with the overall risk appetite of the markets. And we identify key levels for entry and exit. And what has really improved our trading is we identify the best time to enter a trade as well. On our short-term trades, for those of you that like to trade euro, we trade the euro primarily in our short-term trading signals, and we send you our trading signals via SMS as well as Twitter. We have two types of short-term trades: day trades that enter into the market, day trades that enter when key levels are triggered. So for some of you that like to just put on your orders and just wait for it to trigger, we've got that. For those of you that like to keep on top of the markets and just basically look for opportunities when we provide them, we also have a technique that does so as well. And we communicate and we send out all of our trades on our private Twitter feed as well as via SMS and email. For those of you that like trading education, we provide market-centric education, meaning that we only provide you information that we feel that's important. So every single week we have a news trading battle plan, which outlines our biases for economic data, how we think it's going to fare. We also every single day break that down into a chart, explain to you exactly what we talked about today, which is fundamentals, how the fundamental, technical, and sentiment picture is shaping up for that specific opportunity and currency. Because every single trading signal that we provide does look for support from fundamentals, technicals, and sentiment. And you're not alone, because we always tell you what we trade, why we trade, and give you updates and stops along the way. And I was talking about earlier how we hold live sessions with our clients every day. That's what they get, along with our top 5 hot ideas, chart of the day. We also have a library of exclusive trading strategies, and we have a laboratory of trading strategies. So whenever we have a new trading strategy come out, we send that notification to our subscribers that we have a new trading strategy come out. We hold a special webinar on it, and we to explain to you what the strategy is. And then we also hold a live trading session showing you how the strategy works. Every single day, though, we have specific webinars. Today we did technical analysis. Tuesday we looked at charts, we looked at opportunities, we looked at how Kiwi yen rose to its highest level in 2 years today and what that means in terms of opportunities. Yesterday we set everyone up for trading for the week. Tomorrow we're looking at world markets. Thursday is when we invite you into our laboratory and we talk trading strategies. And then Friday is all about money management. So I do encourage you all to basically, come to our website and check it out, because there's something for everyone here, and basically all of our services are included in terms of trading education as well as trading signals on bkforex.com. So now I'd like to open up the floor to any questions that you may have or any charts that you may want to look at. There's one question about whether I mean diagonal when I say vertical. Yes, diagonal and vertical are less important than horizontal lines, because horizontal lines are usually what you get around round numbers, and we think that's far more important than any type of the vertical or diagonal line that you may have. I don't understand. There's a question about what my settings are for the third line break. I don't, we're talking about the Bollinger Bands. Our settings are 20 period 1 standard deviation, 20 period 2 standard deviations. What was the correlation between the Aussie-CAD? It was more the divergence that we talked about between Aussie and CAD, because what we have is we have the Reserve Bank of Australia cutting interest rates, the Bank of Canada talking about raising interest rates. So that has caused, fundamentally a divergence, and fundamentally tells us that Aussie-CAD should fall. But just because something is happening fundamentally doesn't mean that you should take the trade, because you want support from technicals and sentiment. Because right now, if you take a look at the Aussie-CAD chart like we did, it's actually strong. So that actually gives me very little reason to short Aussie-CAD until we have support from both. Any other questions? Sentiment is a lot harder to gauge, but I look at how equities are performing and how bonds are performing for sentiment. So, like today, we have a really nice rally in stocks, so that tells me that, we do have more risk positive than negative factors. Okay, so if there's no other questions, I thank you all for joining me today, and I encourage you all to please check out our website for more information on our services. And if you have additional questions, feel free to email me and click on contact, and I'll be more than happy to answer them. Thank you so much for having me, FX Street.